Washington has once again announced the introduction of trade tariffs, and this time imposing a 25% duty on the oil, steel, and aluminum imports. According to President Donald Trump, these tariffs will apply without exceptions or exemptions to all countries. However, they are set to take effect only on March 4, leaving a 4-week window, during which things could still change. For instance, today, Trump held a phone conversation with the Australian Prime Minister Anthony Albanese. According to Albanese, the conversation was very constructive and Trump agreed to consider excluding Australia from the general tariff list. However, Canada and Mexico remain on the list for now. Data from the American Iron and Steel Institute indicates that Canada, Brazil, Mexico, South Korea, and Vietnam are the largest steel suppliers to the US market. Besides, Canada dominates aluminum exports to the United States. Essentially, the additional taxes on imports will fall on American buyers, that's domestic US companies, whose higher production costs will eventually hit American consumer wallets. This means the US dollar is likely to appreciate as well. However, the question is how the economy will react to Trump's ambition to make the US even wealthier. For now, US GDP is growing at a 2.5%, but inflation remains far from the Fed Reserve's 2% target. As a result, the US dollar index is trading quietly today, fluctuating within a narrow range of 108.20 to 108.50. Today and tomorrow, markets are shifting their attention from the US trade threats to Fed Reserve Chair Jerome Powell's testimony before the Senate and House of Representatives. Powell's caution stance could potentially boost the US dollar, and his track record suggests he will remain cautious. Economic data is another key factor influencing trading sentiment. Following strong US non-farm payrolls, the upcoming inflation report could further strengthen the US dollar. The consensus suggests that the annual CPI could have grown by 2.9% in January, thus supporting the dollar's bullish trend. For detailed timings of Jerome Powell's speech, as well as other political statements and important economic data releases, check out our Traders Economic Calendar. The threat of additional US tariffs persists, including against Eurozone countries that also export steel to the United States. European Commission President Ursula von der Leyen stated today that the EU will not leave US auctions unanswered and will implement countermeasures. However, the frustrating uncertainty, including the postponement of tariffs until March 4, is likely the biggest concern for the European traders at the moment. Over time, fragile from ongoing tariff threats combined with the exceptional threats to the US economy should prop up the euro's downward trend. However, JP Morgan analysts see a potential upside for the single currency. Ironically, due to Donald Trump's new tariffs, according to experts, these tariffs will not provide explosive strength to the US dollar. Instead, the EU's retaliatory actions in the escalating trade war could actually favor the euro. This may explain today's attempt at a bullish correction in the euro-dollar pair, traded within the daily range of 1.0295 to 1.0332. Key technical levels to watch the resistance level at 1.0345 and 1.0425. In case a bearish scenario unfolds, a decline below 1.2195 could signal a further weakening of the euro. Oil prices jumped by 1% today, with the Brent crude trading in the range of 76 to 77. One of the key factors behind this surge was the reduction in Russian oil supply, and the country's production fell below its January OPEC Plus quote. However, the main driver of the rally was once again Donald Trump's statements. The US president warned that the Middle East truce could be broken if the agreement on the return of Israeli hostages is violated. Meanwhile, natural gas prices in Europe have surged, making oil a more attractive energy source for consumers, and this dynamic potentially boosts demand for crude while partly limiting further price growth. The Russian ruble ended last week with an unexpected strengthening of its position, likely driven by a high supply of foreign currency from exporters. The rally in the oil market this week also had a positive impact on the ruble. As a result, the bullish trend continued today, pushing the US dollar down to 96 against the ruble. However, considering that a sustained increase in the oil prices still appears challenging, the ruble may soon lose this support. Now the market is speculating about forecasts on the Bank of Russia's upcoming interest rate decision. The next meeting of the Russian Central Bank is scheduled for February 14, with its key rate currently set at 21%. So that's all for now. We continue to follow developments in the financial markets. Subscribe to our channel and follow news with us. See you!